Welcome to the world of Forex trading. In this video, we'll explore the dynamics of the Forex market, delve into trading activity and market participation, and understand the role of technical analysis in trading frequency. Let's get started. Only 15% of Forex traders achieve consistent profitability, which emphasizes the zero-sum nature of the Forex market, wherein gains are largely redistributed from less informed participants to institutional actors or highly skilled retail traders. This is in perfect accordance with the Pareto principle, suggesting that a small fraction of participants capture the majority of returns. This systemic inefficiency is further exacerbated by factors such as cognitive biases, inadequate risk management, and the stochastic nature of currency price movements. The temporal allocation of trading activity, with 45% of traders dedicating 1 to 2 hours daily and only 14% exceeding 6 hours, highlights the prevalence of part-time retail trading. Such limited engagement raises questions about the efficacy of their market participation, given the information asymmetry against institutional players operating with high-frequency algorithms and 24-hour market monitoring. Decision fatigue, a cognitive phenomenon linked to deteriorating decision quality with prolonged activity, likely affects traders spending extended periods analyzing charts and executing trades. 41% of traders execute between 9 and 20 trades per month, a moderate activity level that reflects a tactical approach to balancing transaction costs with market exposure, confirmed by the fact that 66% rely on daily charts for their technical analysis. Their preference for daily time frames highlights a focus on mid-term trend identification, cutting through intraday noise while capitalizing on sustained market momentum. Experience, leverage, and risk are interwoven threads in the fabric of Forex trading. A trader's journey is often characterized by the interplay between these elements, shaping their strategies and outcomes in the market. The distribution of trading experience highlights a critical survivorship bias within the Forex ecosystem. With 31% of traders being novices, less than 1 year of experience, and only 7% persisting beyond a decade, the data stresses the attritional nature of Forex trading. High churn rates among newer traders may result from capital depletion due to insufficient strategy robustness, poor leverage management, or failure to adapt to the dynamic liquidity and volatility profiles of Forex pairs. A salient feature of Forex trading is its high degree of leverage, often exceeding ratios of 100 to 1. Leverage indeed serves as a magnifier of capital efficiency, allowing traders to control disproportionately large positions, but it also exponentially increases the probability of account depletion during adverse price movements. This mechanism is not merely a function of financial mathematics, but embodies the probabilistic principles of ruin theory, wherein small probability events, such as sudden geopolitical disruptions or central bank interventions, can lead to cascading losses. In this respect, leverage acts as a double-edged sword, its utility contingent upon the trader's capacity for sophisticated risk modeling and disciplined position management. Let's dive into a fascinating case study, Thomas's trading success. So a 19-year-old trader named Thomas achieved an almost 1,000 times return in just 4 hours. At the core of Thomas's achievement lies an acute exploitation of transient liquidity imbalances. In high-frequency and short-term trading, microstructural factors such as bid-ask spreads, order book depth, and execution latency can be decisive. During periods of heightened volatility, often characterized by significant changes in order flow and rapid price dislocations, the trader's system, even if executed manually via a mobile interface, capitalized on momentary pricing inefficiencies. Techniques such as dynamic order slicing and the rapid rebalancing of leveraged positions allowed Thomas to effectively front-run the adverse selection risks typically associated with such environments. From a quantitative standpoint, the price impact function, often modeled as a non-linear function of trade size, implies that small orders placed under optimal conditions can generate disproportionately high returns when market depth is temporarily eroded. The event exemplifies an environment where the instantaneous liquidity was so thin that aggressive market orders moved prices sharply, an outcome consistent with the theoretical predictions of transient market impact models and the phenomenon of superkurtosis in high-frequency data. Leverage, risk management, and algorithmic trading are interconnected facets of modern financial markets. When used judiciously, leverage can amplify returns, but it also heightens the potential for significant losses. Effective risk management strategies are crucial to mitigate these risks, often involving sophisticated algorithms designed to optimize trade execution and manage portfolio exposure dynamically. These algorithms can process vast amounts of market data in real time, making split-second decisions that human traders simply cannot match. However, the reliance on algorithms also introduces new risks, such as model errors and the potential for cascading failures in highly automated trading environments. The amplification of returns through leverage is a double-edged sword in financial trading. In Thomas's 4-hour session, the effective use of leverage, whether explicit or via derivative exposure, magnified the modest capital base from $200 to an astronomical $190,000, supported by the statistical property of variance scaling with leverage and the sensitivity of value at risk, VAR, models to extreme tail events. In such extreme cases, standard risk metrics like the Sharpe ratio or even conventional VAR may underestimate the potential for catastrophic losses if higher-order moments like kurtosis are assumed to be finite. Thomas's trading session likely unfolded in an environment of elevated realized volatility where the empirical distribution of returns exhibited heavy tails. Advanced risk management methodologies would necessitate incorporating measures for infinite kurtosis or superkurtosis, thereby adjusting capital buffers and stop-loss thresholds in real time to mitigate tail risks. Although Thomas executed trades manually on a mobile platform, the underlying principles are deeply rooted in algorithmic trading theory. Key to his success was an almost algorithmic precision in timing and execution, a hallmark of high-frequency trading systems that exploit latency arbitrage. In modern systems, hardware acceleration, co-location, and optimized software algorithms reduce decision latency to microseconds, enabling traders to capture fleeting arbitrage opportunities. Real-time assessment, psychological factors, and behavioral finance play crucial roles in trading. Traders must constantly evaluate market conditions and adjust their strategies accordingly. Psychological resilience is essential to withstand market pressures and avoid emotional decision-making. Understanding behavioral finance helps traders recognize and mitigate biases, leading to more rational and effective trading decisions. In this case study, the trader's real-time assessment of order flow, supported by live screen captures and instant account statement verifications, mirrors the decision logic employed by state-of-the-art automated trading platforms. His execution methodology likely involved rapid toggling between aggressive market orders and liquidity-providing limit orders, ensuring that positions were entered at favorable prices while controlling for adverse selection. The strategic interplay between these order types is quantitatively modeled by stochastic control frameworks that balance immediate execution risk against the potential for improved fill prices. Beyond the quantitative and technological factors, the psychological disposition of the trader plays a critical role. Achieving a nearly 1,000 times return in a highly volatile environment requires not only technical expertise, but also an extraordinary degree of composure, conviction, and risk tolerance. The trader's ability to adhere to predetermined risk controls, avoid over-leveraging beyond calculated thresholds, and exit positions at optimal times accentuates an integration of behavioral discipline with quantitative strategy. This synergy reflects the fusion of algorithmic rigor with what behavioral finance terms conviction under uncertainty, a rare quality that can drive outsized outcomes when market conditions align favorably. From a behavioral finance perspective, the retail Forex market often attracts participants with overestimated expectations of wealth generation. Anchored by the availability heuristic, potential traders are disproportionately influenced by these outlier success stories, individuals who reportedly transformed modest capital bases into vast fortune. These narratives, amplified by the marketing strategies of brokers and trading platforms, obscure the statistical reality. Empirical studies consistently demonstrate that the vast majority of retail Forex participants incur net losses. Estimates suggest that between 70% and 90% of traders experience significant portfolio attrition, with many exiting the market entirely after unsustainable drawdowns. This discrepancy highlights the psychological and cognitive biases at play, including overconfidence, loss aversion, and the illusion of control. Market efficiency, self-regulation, and systemic challenges are key elements in understanding the Forex trading landscape. The theoretical promise of Forex trading as a wealth generation mechanism is intrinsically tied to its probabilistic structure. Trading profitability is contingent upon the exploitation of inefficiencies or patterns within currency price movements. Phenomena often categorized under technical analysis or algorithmic pattern recognition. However, the Forex market is characterized by semi-strong efficiency, wherein publicly available information is rapidly incorporated into prices. This efficiency poses a significant challenge for discretionary traders, as it reduces the persistence of exploitable edges. Furthermore, the highly stochastic nature of currency prices, governed by chaotic systems of macroeconomic indicators, geopolitical developments, and market sentiment, renders deterministic approaches fundamentally inadequate. In addition to its technical challenges, Forex trading demands a profound engagement with behavioral self-regulation. The literature on decision science highlights the role of emotional resilience and cognitive flexibility in navigating high-volatility environments. Effective traders develop probabilistic thinking frameworks that enable them to view outcomes not as deterministic reflections of their skill, but as manifestations of statistical variance. This detachment from individual trade outcomes, combined with rigorous adherence to predefined risk parameters, constitutes the psychological bedrock of sustained trading success. Notably, such traits are neither innate nor easily acquired, but require deliberate practice, introspection, and exposure to prolonged market dynamics. Beyond individual skill and psychology, the systemic characteristics of the Forex market further constrain its potential for wealth accumulation. Institutional actors, central banks, hedge funds, and multinational corporations dominate trading volumes, leveraging advanced quantitative models and access to proprietary information. Retail traders, by contrast, operate at a structural disadvantage, often relying on heuristic-driven strategies or publicly available tools. This informational asymmetry, compounded by the latency of retail trading platforms and the high cost of real-time data acquisition, diminishes the likelihood of sustained profitability. Moreover, market microstructure phenomena such as slippage and spreads disproportionately erode the returns of small-scale participants. The temporal dimension of Forex success also warrants scrutiny. Popular discourse often implies that wealth accumulation in Forex trading is achievable within a condensed time frame facilitated by leverage and the compounding of returns. However, empirical evidence suggests that the path to consistent profitability, much like the progression outlined in the Dreyfus model of skill acquisition, unfolds over years of focused learning and continuous refinement, where the journey from novice to expert in Forex trading involves not only the gradual mastery of technical, analytical, and psychological skills, but also frequent setbacks and recalibrations along the way. The temporal dimension of Forex success also warrants scrutiny. Popular discourse often implies that wealth accumulation in forex trading is achievable within a condensed time frame facilitated by leverage and the compounding of returns. However, empirical evidence suggests that the path to consistent profitability, much like the progression outlined in the Dreyfus model of skill acquisition, unfolds over years of focused learning and continuous refinement, where the journey from novice to expert in forex trading involves not only the gradual mastery of technical, analytical, and psychological skills, but also frequent setbacks and recalibrations along the way. Forex trading theoretically possesses the capacity for extraordinary wealth generation, but its practical realization is contingent upon an array of interrelated factors. These include, but are not limited to, a trader's ability to handle the probabilistic nature of markets, the structural limitations imposed by the market's architecture, and the psychological resilience required to endure extended periods of uncertainty and loss. Moreover, the pathway to success in forex trading is neither universally accessible nor readily replicable, as it demands a confluence of cognitive, financial, and temporal resources that few individuals possess or are willing to cultivate. Forex traders seeking sustainable profitability must align their execution framework with non-conflicted brokerage structures. The empirical and structural deficiencies of market makers, ranging from systemic conflicts of interest to execution inefficiencies, render them unsuitable for serious market participants. SCN ETP brokers, by contrast, provide a conflict-free trading environment with institutional-grade execution, ultimately maximizing a trader's edge. In this section, we will explore the differences between market makers and SCN ETP brokers. Understanding these distinctions is crucial for any trader looking to make informed decisions in the forex market. Market maker brokers operate on a B-book model, where client trades are internalized rather than transmitted to the interbank market. Consequently, these brokers profit from client losses, establishing an inherent adverse selection bias. The following systemic issues are observed: requoting and slippage manipulation, where artificial order execution delays facilitate price shading and slippage exploitation. Stop hunting mechanisms, where liquidity manipulation induces artificial price spikes designed to trigger stop-loss orders, and spread widening practices, where synthetic spreads are adjusted to amplify transactional costs during high volatility events. In contrast, SCN, or systematic internalizer, and ETP brokers operate on an A-book model, wherein all client orders are routed to liquidity providers. These brokers derive revenue solely from commissions and spreads, eliminating counterparty risk exposure. Advantages include direct market access, or DMA, which ensures execution at true interbank rates with transparency and efficiency. Ultra-low latency order execution, which minimizes trade slippage and enhances strategy reliability, and depth of market, or DUM visibility, which provides full market order book transparency for informed decision-making.